Now, the last couple of examples for this chapter on technical indicators. So to compute the OBV, we're using the OBV function, and we're providing only the close, and the volume needs the volume that to accumulate these values in between days or in between candles. So, and we also need the closing prices. These are details that were mentioned in the presentation on how to compute the OBV. But in all of these cases, as you may have noticed, we're not actually implementing the formulas ourselves. In Python, we have packages that are pre-coded and we can just use them. So we call the function OBV, we provide the data.close and the data.volume columns, and we can store the result in a new column in our data frame that I'm calling here OBV. Then I'm taking a small slice of 500 candles of our data frame, making subplots, providing names and titles for these subplots, and plotting the candles, providing open, high, low, closing prices, and then adding a trace using the scatter function, which is the OBV, providing a name for it and a position and so on. So this is what we have. So we have the price candles here, and then the OBV values for use. So this is just visualizing to know that the function is working and we're not getting any outliers or weird values. We don't have to use all of these indicators, and obviously we don't have to plot them in our algorithmic trading strategy. It's just that we can use the numbers provided by these. And our last indicator is the CMF and the money flow indicator. So there's a function also in TA, technical analysis package, providing the CMF readily for us. So we provide the high, low, close, and the volume data from our data frame, the length, and put it to 14 or 20 or whatever. And then we are taking a slice. Well, the result of this, which is the CMF, is stored into a new column in our data frame. So it's called CMF here as well. Then when I'm taking a slice of our data frame, I can plot the candles, and I can also plot the CMF as well. And we're going to see how it looks like. So this is our CMF. It's also the money flow indicator showing next to our candles or candle charts. All right, so this is it for these examples. You can download all these Python notebook files. You can copy and paste and change the values just to observe how things and practice on your own actually using this library and the Y-Finance library, and maybe experimenting on the plots as well. And now we can talk about how to test technical indicators without using a full strategy backtest or any fancy backtesting libraries, only by focusing on correlations and simple candle counting, which can provide valuable insights into the potential effectiveness of any technical indicator. So I honestly can't stress on this enough, because this is the easiest way we can start to test our trading systems, or at least a small part or a small component of our strategy, which is the technical indicator. And this type of testing doesn't require any backtesting and complex approaches. It's just trying to see if there is any kind of correlation between our indicator and the future price movement. So here are some example approaches that can be applied to technical indicators. We will not detail all of these methods. Some of them are more interesting than others, but it's good to have an idea of this list of approaches, as these can be helpful in some particular situations. The first point to talk about is the correlation with price movement. So usually this refers to the statistical analysis of how well a particular technical indicator would predict the direction of the price movement, the future direction of the price movement. So this is done by comparing the historical price movements with the readings of the technical indicator and applying a correlation test. So a positive correlation would mean that as the indicator increases, so the price also tends to increase, and vice versa. So this can help traders understand the effectiveness of a particular indicator in predicting price movements. Of course, this approach works only for some types of indicators, such as the trend indicators, while other indicators might not have a direct correlation with the future price trends. The second point is the cross-validation with price trends. Cross-validation in the context of algorithmic trading is a technique used to validate the performance of a trading model. It involves mainly dividing the historical data into a training set and a test set. If you are familiar with machine learning, you would be very acquainted with these methods of slicing your data set into a training set and a test set, and sometimes also a validation set. The model is trained on the training set and then tested on the test set. This helps to assess whether the model can generalize its learning to unseen data, because when we split our data into a training and testing set, we are only using the training set for fitting the indicator. So we are tuning the parameters of the indicator for the best results on one slice of the data, which is the training set. And this is because we want to assess the performance of the indicator on new or unseen data, which in this case is the test set. So we wouldn't use the test set until everything is finished, all fine-tuned, and all the parameters are tuned. And in this case, we can start using the test set just to assess the performance of the technical indicator. In brief, the steps are the following. You divide your data set into training and testing sets. Then we tune the indicator on the training set and observe its behavior on the testing set. Then we can check if there's a consistent correlation between indicator values and price trends in the testing set. The third approach we can talk about here is the candle counting and average price movement. And I think this is one of the most practical approaches that we can start with. And I'm going to provide some Python examples later on this approach in the following videos. So this is a simple procedure of counting the number of bullish and bearish candles after a specific indicator conditions. For example, indicator crosses a certain threshold. The RSI crosses, let's say, a certain threshold. It's going above the value 70. Then we want to check if we have a red candle afterwards. So do we have a red candle within the next 3 candles? Or do we have 3 red candles? Or any kind of pattern, future pattern that you want to test the indicator on. So is the indicator a good forecasting tool for such a pattern? Or also we can calculate the average future price movement for each technical indicator scenario. So instead of considering few candles in the future or subsequent candles after the current candle, we're going to compute the average price of the next 5 or 6 candles. So instead of looking at the direction of the candles, we're computing the average price. This way we can compare the average price with the closing price of the current candle, and we can have an idea if the average price of the future candles is above or below the current price of the current candle. So both of these approaches, taking the future candles or the average price of the future candles, allow us to determine if there's a statistically significant difference in the average price movement. It's basically looking at the same thing from two different perspectives. I'll be providing a Python example where we will see how to use both the candle counting approach and the future price average to evaluate a custom indicator. So if it's not very clear at this point, that's okay. We'll be going in details with a Python code later on in a couple of videos. We can also use rolling windows analysis. So rolling windows analysis is basically a technique used in time series analysis, which involves creating a window of a certain size, or I would say a time window, a slice of the data that moves along the data series. This can be used to analyze price movements over a window period or a certain period, such as the last 10 days, for example, and then it can help identify trends or patterns. So if we check the trend in the last 10 days, the slope of the moving averages, for example, we find it's a positive slope. This is how we can analyze the current trend in the time window or the time slice that we are considering, which is the 10 days in this case. So it can help identify trends or patterns for the considered time window and extrapolate these trends into a forecast. We consider that whenever we have a trend, within 10 days, it's going to continue, let's say, at least for 2 days in the future. And this is how we can base our trading on this assumption. So in brief, we use a rolling windows to analyze the slope of a changing indicator, for example, and we use this information to extrapolate for the future. Then we can use the directional movement category. It's simply splitting the future price into 3 categories: an uptrend, downtrend, or a ranging price, depending on some thresholds and criteria. For example, we can check the average price of the next future 5 candles, for example. If they are above a certain threshold from the current candle's closing price, then it's an uptrend. If they are below the current candle's closing price within a certain threshold or above a certain threshold, then it's a downtrend. And if they are hovering almost around the current candle's price, then in this case, we have a ranging market. And so it makes the forecasting easier to predict, because we are only trying to predict one of 3 categories, either an uptrend, a downtrend, or a ranging market. Then we can use the directional categories to check if they correlate with our indicators. So now we have 3 categories of the future of the price, and then we can try to correlate these with our indicator if we are trying to test an indicator. So we can assess whether there is any correlation between the indicator and the future price category. And after this, we can track the percentage of correct directional signals and measure their significance. So we would have a percentage of how many times our indicator predicted the trend or the future trend correctly. For example, we can apply this to the ADX. So we can check the directional movement indicators, such as the plus DI and the minus DI, to determine the strength and direction of a trend. And we can compare this with the real future price category, an uptrend, downtrend, or a ranging price. And we can count the number of times the ADX estimation of the future price was correct versus the times where it was incorrect. This way we can evaluate this indicator, just as an example. And this would also allow us to change the parameters of the indicator and to fine-tune it for the maximum accuracy. We can also proceed with a volatility analysis, dividing the data set into different volatility types or regimes: high volatility, low volatility, and probably medium volatility as well. So we can analyze the indicator's performance during low and high volatility periods, because some indicators might work in a specific set of conditions. This way we could test and know in advance, so we can use the indicator in a more effective way when the market conditions are optimal. We don't expect all the indicators to work in all different volatility types. So some indicators might be specifically good for low volatility markets, and some others are good for medium or high volatility markets. Another relatively simple approach is the selected pattern studies. In here we identify specific events or patterns in the indicator that usually precede significant price movements. For example, a tightening in the Bollinger Bands is usually known to be followed by a high volatility or a quick price change, because we assume that a very narrow Bollinger Bands width is related to a very low volatility, which is unusual on some assets. And then we expect immediately after, within a couple of hours, a jump in the price, either in an uptrend or in a downtrend, depending on other conditions. So we can test the consistency of these patterns in predicting price changes. Also, another example is the RSI divergence. We can check how many times when we have an RSI divergence do we have a trend reversal. This way we can have a certain percentage of the accuracy of each of these indicators. Final point I would like to mention are correlation heat maps. So usually a correlation heat map is a graphical representation of the correlation coefficients between different variables. In the context of algorithmic trading, this could involve creating a heat map of the correlation coefficients between different technical indicators and future price movements. So we can check which technical indicator is the has the highest correlation with the future price movements. So this can be done across different market conditions or time periods. For example, we can test a technical indicator with different parameters, computing the correlations of these different parameters setups with the future price movements. Let's say you want to test different length of analysis for the same indicator. For example, the RSI 25 or 25 or anything else. And we can plot a two-dimensional heat map showing correlations between the indicator values and the future price average for different lengths. Just like the RSI, for example, we can use it with the length 14 or 20 or maybe 10. You get the point. We can plot the price movement correlation with all of these values on a heat map to see which length will provide the highest correlation. In the coming videos, we will dive deeper in some examples that might fall in these two categories: the candle counting and the average price movement, and the selected pattern studies, more precisely the rejection patterns. So we'll give the rejection patterns as an example. We'll show the code in Python. We'll go through the details to see how we can test such indicators. Then we will see how to use these testing methods in Python so you can get inspired to come up with new methods adapted to your own strategy. In this video, we will be focusing on two of these categories. So we'll use approaches that fall within these two categories: the candle counting, the future candle counting, and the average price movement, the future average price movement. So these are relatively simple. We'll see these in Python. I'll provide an example and we can see how we can test these in details. And we will be also using selected pattern studies. So checking the rejection pattern, for example, and testing if this pattern can be correlated somehow with the candle counting, the future candle counting, and the future average price movement. One easy way that we can detail in this video to test the technical indicators is the correlation with the price movement. So what we will do is to calculate the correlation coefficient between the values of the indicator and the subsequent price movements. So taking, for example, the rejection candle as an indicator, I'm taking a very simple case here, like just a rejection candle happening here, which is a bearish rejection signal. And what we will do, we'll check the average closing price of the future 5 candles, for example. And we will have an average price, which is below the closing price of the signal candle. Then we compute the difference between the signal candle's closing price and the average of the future price. And this is a negative difference because we have a negative trend here. In the other case, sometimes we would have a positive trend. So for example, this one is a rejection candle followed by, I would say, 3 or 5. I don't know where the average would be, the average price, but imagine it's going to be a positive one, and so on. And we can check two columns. We will have two columns of data, like a negative or a categorical variable showing that this is a bearish rejection candle. So we would have bearish signal and the price difference. So categorical and a numerical value. Then a bullish signal in the second row and I don't know, maybe a positive price movement, and so on. And then we can compute the correlation between the signals and the future of the price. And this way we can evaluate, is there a real correlation between the signal I'm considering and the future of the price? But remember, there are some parameters to be tuned. We can easily apply these statistical correlations. In Python, you have functions like the ANOVA test, the student test, and any kind of inferential statistics tests. But the issue is, how many candles in the future would you consider to test your correlations? And this is why we can examine the correlation over different time horizons, 1, 5, 10 future candles, for example, and see which one works best for the current indicator that we are considering. This is a very easy approach where you can evaluate the correlation of your indicator with the future of the price movement without really going into a lot of details and backtesting strategies and having to implement a trade management approach as well. And you never know if the problem in this strategy is coming from the indicator or it's coming from your trade management approach. So it's a good way to isolate your indicator from any other components in the strategy or in your trading system. So you can evaluate the trading indicator alone before proceeding and plugging it into a trading system. If you don't want to go for correlation coefficients and statistical inference, there's a different and easier way to do this, a very simple approach where we can check what's happening after the rejection candle. So I took the rejection candle here as a simple approach, as a simple technical indicator. This one here is followed by a red candle. We can simply count how many times a bearish rejection candle is followed by a red candle or a bearish candle. and how many times this same candle or same pattern is followed by a false signal, so is actually a false signal, so it's followed by a green candle. This way we're looking just at the signal candle and only one subsequent candle, which is straight after the signal candle. So we can check this on usually larger time frames, the daily time frames, the 4 hours time frames. I don't expect it to work well on lower time frames because you might have a lot of noise. So even if your signal is a true positive, it might not be seen straight afterwards, just on the first candle that's coming. You have to wait sometimes 3 or 4 candles to see that the signal was a true positive. But on larger time frames, usually the daily time frame, this works well. So that's one way of doing it. There's a different way where we can use the future candles and compute the average price of the future candles and just comparing these with the closing price of the signal candle. If the future price, the average future price, is lower than the current candles, then it's a category -1, for example. If it's above, then it's a category +1, which is positive. And if it's almost within a range of the current candle, let's say it's a category 0. And this way you would have two categorical columns. The signal, if it's bearish, bullish, or no signal, and the future category, is it bearish, bullish, trend, or arranging a pattern. So using this approach, we can test or count the number of times the prices are hitting a category up or down using either the next candle or the average price after the candle pattern is detected and we get a signal. So we can check what is the percentage of the times where our signal was a correct one, was a true positive one, versus the percentage of the times that we had a false positive, in the sense that we had, let's say, a bullish candle, a bullish rejection candle, but followed by a downtrend rather than an uptrend. So we can also apply correlation tests on the pattern occurrence and the future price category. This is something we already mentioned. So we can imagine two columns. One column is our signal. So if it's a bearish rejection candle, then our signal is -1. If it's a bullish rejection candle, then we consider a signal +1, for example. So that's our first column of data. And the second column of data is the real category of the future of the price. So we can compare what we are forecasting as a category and the future of the price, either a numerical value or a categorical value if we are categorizing the future of the price, uptrend, downtrend, or no trend. So this is how we can test indicators very quickly without having to use any full backtesting trading systems or full backtesting trading strategies using money management, lot sizing management, exit strategies, entry strategies, and so on. This would be too cumbersome and it would drown the quality of our results on the technical indicator in so many parameters, which makes it impossible for us to assess the quality of the technical indicator. Remember that the goal here, the main goal, our main goal at this stage of the course is to be able to test the technical indicator in isolation. In this video, we will be testing the rejection signal, and I will show you how we can test this indicator on a set of data. So first of all, we need to acquire the data. I'm using YFinance and Pandas, and I'm downloading the Bitcoin US dollar between the starting and the end date and the daily time frame. So we're downloading this using YFinance and run this now. And then we can just filter the rows where we have a high which is equal to a low price. So these are candles where we had no movement at all. So the high value is equal to the low value, which means that the candle is non-existent. Basically, we didn't have any movement. So these are days of holidays, weekends, any days where the market was closed, and we don't need these in our data. So then we reset the index and we print the data frame to check the content. The content looks like this. So we have the date as a column now. We have an integer index. We have an open, high, low, close, and the adjusted closing price, and then the volume column. So everything is working as intended. Now we can define our indicator. So I want to detect the rejection signal, the rejection candle. In this case, I'm dividing it into two parts. This is a function. I'm defining function. It takes the data frame as an argument, as an input. And we can start by detecting the bullish signal. So if the open of the current candle, which is the last candle of index -1, if this open is less than the closing price, so this is basically a green or an upward candle, and at the same time the high value minus the closing value, so that's basically the upper tail of the candle or the upper whisker of the candle. So if this upper whisker or upper tail of the candle is less than the absolute value of the open minus close price, so this is the body of the candle, the length of the candle itself, the difference between the opening price and the closing price divided by 10. So what we're basically doing here is that we are putting a condition where the upper whisker or the upper shadow of the candle is lower than 1/10 of the body of the candle. So if the candle has a very low or short upper tail, in this case, we also add one additional condition where the open minus the low price, so this is the lower shadow or the lower tail of the candle, should be higher than 5 times the body of the candle. So what this does is that it will put a condition on on one shape of candles, which is the bullish rejection candles. So these are the candles with a very long tail below and very short tail above, and they are green. So this is our bullish signal. In this case, we return 2. The function will return 2 as a category of bullish signals. For the bearish signals, it's the opposite. The upper tail is greater than 5 times the body of the candle, and the lower tail is the short one. It's lower than the body of the candle divided by 10. And in here, we return 1 because this is the bearish signal. And in any other case, we don't have any signals, so the function will return 0. So this is our first rejection parameter or rejection signal, and we can test it already. We also can define another signal. I try to define the engulfing signal, for example, using engulfing candles. And for this, I'm using 2 candles to check the engulfing signal, the current candle and the previous candle. Notice that the indexes here are -1 and -2 for the previous candle. And then I'm checking if the current close of the current candle is above the opening price of the current candle, so it's a green candle, and at the same time the opening price of the current candle is below the previous candle's closing price, and the previous candle is above the previous candle closing price. So it has to be a red candle followed by the current candle, which has a green candle, and at the same time the opening price of the current candle is below the closing price of the previous candle. This is how we can identify a bullish engulfing signal. As for the bearish engulfing candle or the bearish engulfing signal, we have the current candle's open is above the previous candle's close. At the same time, the previous candle is a green one. It has the closing price above the opening price. And at the same time, current candle close is below the previous candle open. So this is what makes it an engulfing candle. This is where we return 1 for a bearish signal, and in any other case we return 0 because simply we don't have any signal and these conditions are not met. Now we can apply any of these functions. So we can apply these to all the data that we have, and we can store the results in a new column called rejection signal is equal to signal here. And I'm using for the first one, which is the rejection signal, I'm using this function, the rejection signal function, basically the first one. And the second indicator or the second signal is stored as an engulfing signal. So we can test these on a daily time frame for the Bitcoin, for example, US dollar between these 2 dates. And the reason I'm telling you these details is that because sometimes some of the indicators would work for a period of time, but then they stop working and then they start working again. You have to keep in mind that the signals sometimes or the indicators might be perfect for a period of time, but then they could stop working for a while. And but this doesn't mean that they are bad indicators. It's simply that the conditions are different on the market. Now to start counting the number of up counts, down counts, and the total counts, we can, for I in range over the whole data frame. And if the data frame engulfing signal I is equal to 1, so if we have a bearish signal as an engulfing signal, we can count the number of times we have this signal. This is the total count. And we can also count how many times the closing price of the following candle, so it's candle I plus 1, was above the opening price of the following candle. So how many times we had a bearish signal, but at the same time followed by a green candle in the opposite direction. And how many times we had a bearish signal followed by a bearish candle in the future. So just a subsequent candle. And we count both occurrences, so up count, down count, total count of signals. And then we can do the percentage. And we can see that for a bearish signal, apparently we're having more, around 68% of an opposite signal. Let's run this again actually and make sure we are on the same page. So yeah, so we have for bearish signals 68% of the times we have these signals, they didn't predict a correct behavior, a correct trend, future trend. So that's an up percentage for a bearish signal. So this is the opposite. But in 31%, we had a good forecasted trend. So this is not really nice for trading. I wouldn't trade using only this candle. And in total, we had 19 signals on a data set that we have downloaded. We can print these rows to get the details of these candles on these specific days. So I'm printing the data frame wherever I have an engulfing signal that is equal to 1. So it's a bearish engulfing signal. And these are the signals right here. So ideally, you might want to plot these. So for example, if we check, let's run this again, and I'm going to plot this part. So this is the candle index 4. Let's check it out. So index 4 should be right here. It seems that, let's zoom in. This one. So index 4 is this candle, and it looks like it's an engulfing candle. It's a bearish engulfing candle. And it was followed actually by a red candle. But counting the number of occurrences, it didn't look promising since we've had only 31% of the times we are correct, or the indicator is correct. We can also check another one. Let's check, for example, the candle 130. Plot this again. And 130 is somewhere around here. So it's this one. I'm going to zoom in again. So 130, it's not very much seen, but it's an engulfing candle, the bearish engulfing candle. And this is one of the false signals because it was followed by an uptrend and green candles. Okay, now obviously we can check the same we can do for the bullish signal. So if we want to check, instead of 1, I'll be putting 2 here, and we can run it and run the percentage testing cell. And the bullish signal works a bit better in this case. So we are forecasting an uptrend, and in 56% of the times it's working. However, 43% of the times it's not working. It's providing a signal, but then the trend is going in a different direction. When we say trend here, I'm using only one subsequent candle. We might want to take the future average, or the average of the future candles. And to visualize the bullish engulfing candles, I'm going to plot this again. We can isolate these by changing the signal filtering here. So signal equal to 2. And we have, let's say, 126. So 126 is this one, the green one right here. This is a bullish engulfing candle on the 126. So this is this one. So if we check the math and the values of these two candles, we notice that this one is engulfing the previous one. However, we didn't have a green candle afterwards, but the trend went up. So zooming out again, 126, and we are followed by a slight upward direction. So instead of only using one subsequent or one future candle, we can check the average price of the next n candles. And this is probably more accurate in this case, the way we are testing things. So we're going to define a new function called average next n candles that takes three parameters: the data frame, parameter I, and then an n, number of future candles. We're going to check if there are n candles after the current one. So if I plus n is greater or equal than the length of the data frame, then we return none because we don't have any future candles. We've already reached the end of the data frame. Then we're going to compute the average closing price of the next n candles. And this is done very easily by slicing using pandas. So I'm taking the df close column, the closing prices. I'm using the iloc between I plus 1, the next candle, and I plus n plus 1, the next n candles, dot mean. So we're computing the mean values of the closing prices within this slice. Then we're going to compare the average price to the current closing price. So if the average price is lower than the closing price of the current candle, so candle index I, or in this case we return 1, and otherwise if the average price is greater than the closing price of the current candle, we're returning 2. In any other case, we return 0. N is equal to 4, so I'm using 4 future candles, and the signal is equal to 0 at first, so I'm filling the list with zeros. And for I in range over the whole data frame minus n, because we still need the last few candles as edge case, the element signal I is equal to the average next n candles function result. So it's going to be one of these, either 1 or 2. So if it's a 1, meaning it's a downtrend. If it's a 2, it's an uptrend for the future price. And this is the price target. We're going to call this new column price target and keep the values in our data frame. And next, the comparison becomes very easy. We're going to check when is the engulfing signal equal to the price target. If they had been heading in the same direction, it means that our forecast is equal to whatever happened for the price target or the future average of the price. And this way we are testing both directions, the positive and the negative category. We're counting how many times these two signals were equal, and we have 20 times. So 20 times the signals of the engulfing pattern corresponded with the future of the price. We can also count this as a percentage. So we're defining here 3 different variables. We have the equal count. So this is the true positives. We have a different count. This is the false positives, so the false signals, and a total count to compute the percentages. So for all the data frame, we're checking the engulfing signals of the current candle. It's different than 0, so we have a signal, and we're total counting the whole set of signals. So in this case, total count is basically the total number of signals. If the engulfing signal of the current candle is equal to the price target, so that's a true positive, that's a good one. So equal count is plus 1, so we're incrementing equal 1, the variable. Otherwise, if they are different, then it's a false signal, and we're incrementing different count. And then we can compute the percentages very easily. The equal percentage is equal to the equal count divided by the total count times 100. And the different percentage is the different count divided by total count times 100. And then we can print this. So we print the equal percentage versus the different percentage. This way we can check if these rejection patterns or engulfing patterns are actually worth it. We don't have to trade things blindly and risk our money for it. And just to listen to people teaching you about engulfing patterns and rejection patterns and so on. You can simply test these very easily in this program. Let's run it from here. So I'm defining the function. I'm running second cell, this cell, and this one, and we get 39%. The engulfing signal was correct, and 60% we had a different future price than whatever the engulfing signal forecasted. So I wouldn't say it's a great signal in these conditions. Now remember, we're using this on the Bitcoin US dollars, so it also might be asset dependent, and we're using it on a daily time frame. And we are also defining the future average of the price. So that's the price target using only 4 candles in the future. Maybe the price didn't have the time to move enough in those 4 candles. As you can see, you have different parameters that you can tune. It's not always very easy or very simple, but at least you have a starting point where you can use your indicators here in this code, apply modifications to the code, and test the validity of your indicator if it has any correlation or any advantages over the market for forecasting. Okay, welcome to the heart of our course. It's probably one of the most interesting sections because this is where we start talking about building a full trading strategy. Before we continue, it's very important to keep in mind that the methods we are discussing here are those that apply to algorithmic trading. So there might be an overlap with manual trading concepts, or sometimes in manual trading we have a better way of solving some situations. It's not always the case in numerical trading, and some differences might be observed. So just keep in mind that whatever we are defining and explaining here, it's meant for numerical trading or algorithmic trading. And in brief, we need trading methods that can be easily coded into a coding language such as Python. We will highlight important steps with some examples and details that would allow us to construct a robust trading strategy. So we emphasize the pivotal importance of recognizing and respecting each component, just like pieces of a puzzle that collectively form a complete trading system. Trading is not merely about finding an entry point and hoping for profits. It's definitely not gambling your money with a feeling about the market direction. It's a very meticulous work and coordination of various elements that must be harmonized seamlessly. So just like a successful business integrates marketing, operations, and finance, a flourishing trading strategy comprises distinct components that, when understood and applied correctly, will increase our probability of success. So that's what we are aiming for. Just look for those tiny bits of percentages of success rates that we will be adding together, stacking together into our trading system, hoping that at the end it will be a full profitable system. The reason I'm mentioning the orchestration part between the different modules of a trading system is because I have seen many strategies working in some way, and if one of these components is modified, then the whole strategy will stop working. In a nutshell, there is no room for approximation. So that's what I'm trying to say here. Details are very important because just like brokers and the market are looking to squeeze 1 or even 0.5% out of our pockets as fees and spread and commissions and so on, we should be dealing with the market in the same way, looking for every 0.5%, 0.1% of improvement that we can achieve and stack these together, because this small percentage of improvement might be the gate to a whole winning strategy. For example, if you have an indicator with 50% accuracy, we know that a risk-reward ratio lower than 1 to 2 will not lead to good trading results. At the same time, this 50% accuracy is affected actually by the risk-reward ratio. Well, the accuracy 50% is computed based on a certain price movement. So let's say your indicator says uptrend. For how long does the price go up before you consider this as a successful forecast? If you put a faraway distance, you will increase the risk-reward ratio, but you will decrease the win rate simply because it's less likely for the price to move that far within a limited amount of time. So again, if you put your risk-reward ratio to 3 to 1, for example, then you are forcing the price to go 3 times as much as the stop-loss distance, and it must reach that far, so the 3 to 1 distance, to consider this as a winning trade. So somehow this is less probable situation than when you squeeze your take profit just very close to the entry point. This is how things affect each other's in trading. So this is just a simple example to show you that all these parts of a trading strategy are interconnected and are far from being totally independent parts. In the sessions ahead, we will delve into the core pillars, which are the trend identification and position filtering. We'll explore methods to discern trends and filter positions that align with the market trends, ensuring that our trades flow in harmony with the prevailing market sentiment. So we don't want to go against the market. The next point is choosing a strategic entry point. Once we have identified the trend, we need to choose an optimal entry point. We will discuss strategies and indicators that guide us in selecting optimal entry points, ensuring that our trades will start at points of calculated advantage. This is how we will squeeze every small percentage of success into our strategy. Remember that any small percentage that we can bring as an improvement will increase our total profit. So 0.5% might not seem much as an example, so as an improvement. But if you consider this on a yearly basis and depending on the trade size, it might become a large sum at the end. The third point we can talk about is the intelligent exit strategies. Just as you enter at the correct moment, we should also exit the market at the very correct moment as well. We'll define exit strategies that align with our broader trade management, guarding against potential losses, securing profits when the timing is correct. The fourth point is managing risk and position sizing. It's important to consider the previous components while defining how much are you willing to risk for each trade or every day, maybe, or any other schema of risk management. We'll explore methods to determine the size of our positions, ensuring we navigate the market with prudence and adapt to varying levels of trade certainty. So not all the trades are the same opportunity. Some of them might be a bit risky, and this is where we need to decrease the trading size to decrease the risk and keep this risk under control. Understanding and integrating these components is crucial to constructing a finely tuned instrument. Each element will contribute to the whole crafted trading system. If you neglect one of these elements or any of these components, you can disrupt the harmony in between these parts, potentially leading to loss results. You don't have to include all of these components in all the trading systems that you will build. If you know what you are doing and you say, I'm going to skip the trend detection, for example, because I'm not dealing with trends in this strategy, then it's fine. But if you want to build a classic pattern strategy, then checking and thinking about each of these components is very important. So buckle up for a journey where theory meets practice, where we not only understand the concepts, but also learn how to weave them into a comprehensive strategy. It's not just about making trades, it's about building a trading system that withstands the test of market dynamics. In most of the cases, and whatever your trading system is, you will probably need to define the trend. Unless if you are trading trendless systems such as the grid and hedging approach, but we're not discussing this type of strategies in this course. So understanding the market trend is crucial for making informed trading decisions. And this is the first step you will need to master while building your algorithm for trading. The first point we can talk about in here is how to identify the trend indicators. So first we need to identify the trend, and for this we will need a proper indicator. The easiest to start with are moving averages or the VWAP as well, which is also one of my favorites for lower time frames, such as the 5 minutes or the 15 minutes time frames. You might want to try other common alternatives, such as the MACD or the Bollinger Bands, but this is up to you. You can experiment on this later on after this course. We will discuss how to program a function to detect the trend in Python later on in the following videos. And of course, there will be downloadable material that you can use as building blocks or starting points while you are building your strategy or your algorithm. Methods for trend detection are using the moving average slope, 3 moving averages alignment, and the price candles above or below the moving average or the VWAP. So if you are not familiar with these 3 components or 3 methods, don't worry, we'll go through the Python code line by line. I'm going to show you how to code the 3 of these methods, and how to detect the trends numerically in Python. Once we have detected a trend, we can confirm the direction and the validity of the trend. This can be done using different methods by comparing, for example, short-term and long-term indicators. If the same trend is detected on 2 close time frames, this might be a good indicator that a trend is established. We can also confirm a trend using other indicators. The ADX, the Average Directional Index, is a good candidate to confirm the strength of a trend, as we have already mentioned this in the previous sections of this course, where we describe technical indicators. A rising ADX suggests a strengthening trend, while a falling ADX may indicate a weakening trend. For example, the ADX is rising above a certain threshold, 25, for example, as value, may confirm a developing trend. And an ADX above 40 would confirm a very strong trend. These are just few examples. Of course, you can extrapolate this knowledge and experiment on more indicators in different configurations. And this is the beauty of algorithmic trading. You just need some time and a bit of knowledge, and you have your own lab where you can experiment in any desired direction. So when all of it is set, we have the trend, it's confirmed, we know the strength of the trend, and we take a decision. We need to discuss how to filter trade positions to align with the identified trend. This could involve using moving average crossovers or trend strength indicators or anything else. So in my case, I simply filter the positions in the direction of the trend. So if the trend is an uptrend and it's confirmed, and I know it's a strong upper trend, in this case, I will only consider long positions. I would never go against the trend or against the market using short positions in such a situation. In the opposite direction, if you have a downtrend and it's confirmed with a certain strength above, let's say 25 or above 30 ADX, then in this case, we will only look to short the market and would never try to go against the market because the odds wouldn't be on our side. This is how I use filtering positions for my trading with the trends. The second step in a strategy is to define an entry point indicator. So we already defined the trend. We already confirmed the trend, and we know in which direction we want to go with the market. So is it a long trend, it's a short trend, and so on. But when to enter the trend, when to join the wave, when do we join the uptrend with a long position, and when do we exactly join the downtrend with a short position? So this is the second step. Once a trend is confirmed, we need to enter the market. And for this, we need to choose an entry point that would maximize our chances and decrease our risk. Selecting an optimal entry point is another key point to the success of any trade. Remember that we want to squeeze out the maximum for each trade. So each trade is a challenge on its own. So we're going to try and think about each of these steps of trading before taking the trade. And defining the entry point is one important step that we need to be considering. Some common entry strategies are to use classical indicators, which belong to families like the breakout trading, mean reversion, or pattern recognition. For example, we can use any of these methods. Either the Bollinger Bands crossing. If the candle goes above the Bollinger Band, it's very far from the center of the band, and we expect the price to retrace back towards the center of the Bollingers. And this is one thing that we can use to our advantage. This is one information that would tell us it's a good entry point when we are outside of the Bollinger Bands, above or below the Bollinger Bands. So obviously, if we are on an uptrend, the price is going up, we are looking for long positions, we would wait for the candles to go below the Bollinger Bands, because this is way too low for an uptrend. This is where we can trigger our entry position or put an order, a deferred order for the future. Then we can use also candlestick patterns. We can try and see if we have any rejections. Again, if I take the example of an uptrend, we're looking to long the market. In this case, we would be looking for a retracement, maybe below the Bollinger Bands, the lower Bollinger Band line. And also we would be looking for a rejection candle, a special candlestick, either a rejection or an engulfing candle that would signal that the market is going up from this point onward. The third point we can also consider to enter the market is using price action and breakout patterns. So usually these patterns depend on key levels, either channel lines or support and resistance levels. So it's a bit more complex. You need to compute these first before you consider price action and breakout patterns. But nevertheless, these can also be used as triggers for entry points. So at this point, we know we have an entry point signal. Do we take it automatically? We could eventually, or we can also look for a confirmation. And usually here, it's not a very complex step. You can use two different indicators as entry signals. For example, if I'm using the rejection candles, I can combine these with a low RSI value. The low RSI value is signaling probably a future uptrend or the price reversing towards the upper side. And if we are in a long trend up, a long-term uptrend, this would be good to combine rejection candles also with some other indicators such as the RSI or even the Bollinger Bands crossing. Most importantly is that we need to confirm a signal with another signal together. So it's better to have 2 or 3 different signals as a general assumption. Now, I have seen strategies working better when they are simple. Cluttering a lot of confirmation signals on top of each other's will decrease the sensitivity of your setup, in which case you would have very rarely a signal and you would open very few trades on the market. So if you want to go the sure way, but have one correct and true positive signal per month, you could eventually combine a lot of signals together. But if you don't have the patience and you don't have to go this way, depending on your trading style, if you want more frequent trading, then we need to use simpler strategies. At the end, when all is set, when you have your entry signals and you decided on which kind of combinations you want to do with the confirmation and so on, we can try and backtest these signals. And by backtesting, I don't mean any complex operations of backtesting. It doesn't have to be numerical. We can simply plot these signals on a chart, on a candlestick chart, and then validate these signals visually. I personally like the visual validation because we can see how the signals are behaving, what is happening on the chart. And this is how we can correct and fine-tune the signals a bit, fine-tune our program, triggering the signals a bit. So I usually use visual validation for this type of testing of the entry signals. The last point we can discuss here, and in my opinion is the most challenging part of a trading system, is how to define an exit strategy that aligns with the trade management that we want to apply. Usually a well-defined exit strategy is a crucial step for risk management and maximizing your profits. Profit-taking strategies can vary from taking profit considering risk-reward ratio, like a fixed risk-reward ratio, or a trailing stop, which is mainly following the winning trade to the maximum to maximize the profits, or using indicator signals like technical indicators, for example, the RSI values. If you are longing the market and then the RSI crosses above, let's say, the value of 75, then you want to exit probably and close your winning trade because most probably you will have a retracement because the market is overbought. Then a fourth point I'd like to mention here is exiting the market when you have an opposite direction signals. So if you have a rejection candle, for example, in the opposite direction of how the market is trending now, then this is a good way, this is a good signal to avoid the retracement and decreasing your profits. So in order to maximize your profits, if any of these signals is on the market, you can exit the market. So similarly, if you are shorting the market, so you have a downtrend, you shorted the market, and the entry position was an excellent one, you are happy about a winning trade in the downtrend direction. If you see a bullish engulfing pattern, a bullish engulfing candle, that might be a good way or a good signal to exit the market now, because there might be a small retracement and your profits will be decreased. And also we need to take care of decreasing our losses. So this is where stop loss strategies come into play. We can either use a fixed stop loss value, considering a risk percentage, and this is usually tightly correlated with your take profit value. So if you have a risk reward ratio that you want to consider, these two, fixed stop loss and fixed take profit distances, are very linked together. Or we can check the volatility-based stop losses. So we can trade the market as long as the volatility is under control. And then when we start seeing high volatility or unpredictable volatility on the market, maybe it's good to exit the market. Another way to use volatility-based stop losses is using the ATR, for example, the average true range. In high volatility markets, we can't put the stop loss very close to our entry position, otherwise we would be immediately stopped. Even though we made the correct choice of the trend and the correct choice on the entry point, there's always some noise in a high volatility market, and this might be a good indicator on where to put our stop loss. The issue here is that you don't want to put your stop loss very close to the buying or shorting position, so very close to your entry position, and you don't want to put it very far away because then you would mess up our risk-reward ratio. So that's a tricky part here, where to put the stop loss. It's still debated, it's an open question on the market. You would see all kind of courses on how to use the stop loss. But the good advantage that we have in algorithmic trading is that whatever assumption you will make, you can immediately change it in your code and backtest it and see if it works. So you don't have to risk your money to in a new schema or a new idea to check if it's working on the market or not. You can simply backtest it numerically and you would know what is the best configuration to trade the market in the best possible way. We can also use technical indicators such as the RSI or the Bollinger Bands and the moving average crossing and so on to exit a losing trade. For example, if we have a losing trade that started losing, we didn't start very well, and we have a VWAP underneath, we are expecting the VWAP to be our support to save our trade, and the VWAP is crossed, so the candle will be crossing below the VWAP. We know that there has been a breakout through the VWAP, so we don't really expect the price to go back up. We don't have to wait in this case. We can just close the position, even though we have a small losses, and it's better than having a large loss. This is how we can manage our trades even after they are opened. The last point we can talk about is the price action and candle patterns. Again, if we have a losing trade and then we notice that there is a rejection in the direction that wouldn't be to our advantage, so it's going to continue with the losing trend, then we can also use it as a stop loss signal to stop our losses and minimize these losses. And this brings me to a third point I'd like to discuss. Do we stick to the exit strategy that we already planned for each of our trades that we opened, or do we adapt our exit according to the changing market? Now, I know that consistency and sticking to the system is very important for a winning strategy. However, this is very much true for entering the market. So whenever you are entering the market, choosing the trend and the entry point, yes, we must stick to our entry positions or our entry conditions. But whenever it comes to exiting the market, this is a bit more flexible. And this is where things should be a bit more dynamic, because the moment you enter the market until you exit the market is alive and it's changing. So the conditions might be changing as well. And this is why we can't stick to a set of rules to exit the market. There must be a different sets of rules that should be followed. So it's not one rule to exit the market, it's different sets of rules depending and considering all the possibilities, how the market would behave after we would have opened a trade. So since the market is always dynamic and is always in constant change, so should be our strategy of managing the trades. We can't stick to one set of rules or one single rule. We have to have different set of rules that would adapt with the market. One last point I'd like to mention is the lot size determination based on the trade certainty and the setup. The first point here is the risk-reward ratios. We should always remember that the risk-reward ratio doesn't only depend on the take profit and the stop loss distances. It also depends on the amount of percentage that you're putting at risk for each trade. So how much money are you putting at stake? And this is adjusted also using the lot size. If you increase the lot size, even though the stop loss you are putting is a constant value, then you are increasing your risk in this case. Of course, the risk-reward ratio would be the same, but your risk, your absolute risk, how much money you are risking, is going to increase. So if you are going to manage your trade properly, you also have to incorporate the lot sizing into your trading system. The second point we can talk about is the volatility consideration. So volatile markets are usually fast, but extreme volatility is unpredictable and increases the overall risk. I like to trade in volatile markets. No one likes to wait for their trades for days, especially if you are an intraday trader. So you don't want to wait for 2 or 3 days and leaving your trades opened overnight. So usually we tend to choose a volatile market. But however, as fast as these can be and relaxing at some point, because you can open and close your trades very quickly, and you already know if it's a winning and or a losing trade. In extreme volatility conditions, this becomes unpredictable, and it's more of a gambling schema here. So usually you don't want to trade these markets, especially if you are using a large lot size. So in this case, if you insist on trading high volatility markets, it's better to use very small lot sizes. You can decrease your profits, of course, but you're also decreasing the risk of wiping out your account. Another point we can talk about is how certain are you about your signal? If your signal is a high certainty signal, so if you have, this actually applies when you have different signals. If you have 2 or 3 different signals that you are using for your trading, and you notice that one of the signals is not as good. So when this signal is triggering your entry of the market, you would decrease the lot size because this is your not very good signal. But if your best signal is triggering your entry to the market, in this case, take advantage and increase your lot size. This also can be pre-programmed in Python. So depending on the signal and the certainty of the signal you are having, you can play on the lot size. Now, why we would use 3 different signal types? Why we wouldn't always use the best signal? Well, to increase the frequency of our trades. Instead of having one certain signal per month, you'd rather have 10 signals per month, where one is good, one is very certain, and the 9 others are in different categories. So they are not the best signals, but they are can still make profit out of these. And this is why we can use different signals. However, you don't want to use these signals equally. You can change the lot size because you know that some signals are very rare, but they are gems. If you find them on the market, these are 90% accuracy. And this is when we would increase the lot size with these certain signals. So in brief, if I wanted to put it in one sentence, I would say make it dynamic. Don't make it a static strategy. It's very dynamic, just like the market, and it will adapt with the market. This is how you can increase the odds of you having a winning strategy. In this Python notebook, we're going to see some examples how to detect the trends using the 3 different methods that we mentioned in the previous videos. So the slopes of the moving averages, how to detect these, how to measure the slopes of the moving averages, how to detect the alignment of the 3 moving averages with 3 different lengths, for example, and also how we can detect the trend by counting the number of candles above or below the moving average curve. We can also apply these to the VWAP curve instead of the moving average curve, and this is an example showing how we can do this. And we're going also to check how we can confirm the trend in Python using the average directional index, or the ADX, also as we have mentioned in the previous videos. So we'll go through the details of how to code all of these trend detection methods and trend confirmation method as an example. And I will leave the notebook file, the Jupyter notebook file, as a downloadable file, so you can download this as a resource or as a material, so you can practice using these, and you can copy and paste these functions that you can use later on as building blocks while you are building your trading system. So in this first cell, we're importing yfinance to get the data, and I'm defining a function, get data, that takes a symbol for which we're going to download the data or query the data from yfinance. Then I'm creating a data frame, which is called data. It's a variable for the moment. And I'm using the download function from the yfinance package. And this is where we're going to pass the symbol, which is the parameter or the argument of the function getData, as the parameters tickers. So tickers is equal to the symbol value, and the period is 100 days, which means we're downloading 100 days worth of data. The interval is 1 day, so this is the daily time frame we're working on here. Then I'm going to reset the index. In place is equal to true, and dropping is equal to true, because we need to override the old data frame with the reset index, so that the index by default that was downloaded by yfinance package is usually the date and the time. And I need an integer index, which is simpler to manage for the moment, as long as we don't need to use the date time. Then I'm going to drop equal true, which means I'm going to drop the old index. I don't need to keep it as a column in the data frame. And at the end, we return data, which is the data frame with the candlesticks, open, high, low, and closing prices, and the volume of the trades. So to use this function, I'm going to call it get data for the Bitcoin US dollar prices. And I'm going to store whatever is returned here, the data frame, into a new variable called data. So this is a rather global variable, which is different from the local variable called data within the function. So anyway, now we have a data frame. It's called data. I'm going to run this function for this cell, and we're going to see the data just to make sure that we're working correctly. I'm going to take this and we're going to try to print data here. And this is our data frame. So we have the open, high, low, closing price, the adjusted close price, and then the volume. Now we can import the pandas technical analysis package as TA. And I'm going to define a new function called calculate SMA, which is the simple moving average. It takes a data frame as an input and the length of the moving average that we want to use for the calculation. Then we're going to return ta.sma, which takes, this is a function from the technical analysis package. It's simple moving average. We're going to call it and provide the data frame closing price series, or the column, and then the length. The length, because if you want to compute a simple moving average of length 14, 20, or 100, for example, so this is where it's going to be passed. So we're going just to pass the length parameter from here to the function of technical analysis package. And that's what we're going to return. It's going to return a series, a column that we're going to add to our data frame. That's what we're doing here. So data, this is my data frame, SMA, which is a new column, is equal to the result of calculate SMA with data as an input and 20 also as an input, which is the length of the moving average, the simple moving average. Then we're going to drop an A, because the first few rows are going to be NAs, not numbers, because of the simple moving average with length 20. So the first 20 rows don't have values, because we need at least 20 rows to get the first SMA value. We're going to drop these because we don't have a signal there. We don't have a moving average value there. Now we can compute the slope of the moving average to determine the trend. So if the slope is positive, this is an uptrend. If the slope is negative, this is a downtrend. And to compute the slope, we are defining a new function called calculate_slope. It takes the series. So this is where we're going to input the moving average values. And within the function, we're going to need a slice of time or a slice of candles. So this is where we're going to compute the slope. For example, here I'm taking period is equal to 5 by default, which means that we're going to have a window of 5 candles every time. And within this window, we're going to fit these 5 candles into a slope, or the moving average of these 5 candles into a slope. And this is where we measure if the slope is positive or is negative. So it's an averaged slope over a period of 5 candles. This is what it means. So first we're defining a list of slopes which is equal to zeros. And this is only because if we have a period of 5, the first 5 slopes, we can't compute the slopes for these points for the first 5 candles. So in other words, we need to skip the first 5 candles for which we don't have enough data within the window to compute the slope. So we can start with the 5th candle as a starting point, because we're taking for each candle a window of period 5, so of 5 candles which are preceding the candle, the considered candle. So now we're starting then for I in range from the 5th candle on, so period -1 until the end of the series or the end of the data frame length. And we are setting x is equal np.range period. So these are integers of the same width or length of the period. Here we have from 0 up to 5, 0 to 4 included. And then for the y variables, it's a slice of the series, slice of the moving averages points in this case. And this slice is of width or length of 5 by default here, which is I minus period plus 1 up to I plus 1. So there's always a length of 5 candles dot values. In other words, for each slice of window preceding the current candle, we're checking their moving averages, storing these in Y. We're appending a new x-axis from 0 up to 5, just 0 up to 4, just to compute the to be able to compute the fitting of the slope. And then we use numpy.polynomial fit. We feed x and y in there, first degree fitting, so we just need a slope, and then 0 to get the values. And we convert the slope into a percentage slope by dividing it by y0 times 100. So it's just a slope versus a percentage of the y value, which is the moving average value. We append this value into the list called slopes. Remember, the first 5 values were 0, and then we're starting to append whatever we get from numpy here as a percentage slope. At the end, when all the data frame or all the moving averages were computed, or the slopes for the moving averages were computed, we return the slopes, which is a list here. Now we can create a new column in our data frame. So data slope here is equal to the result of calculate slope data SMA. So this is the series containing the simple moving average which we got from the data frame. And now our data frame would look like this. So we have the open, high-low, closing price, the adjusted closed price, volume, the SMA, and then the slopes of the SMA for each of these candles over the window of 5 candles. So notice also the index, which is an integer now. So we dropped the date time format for the integer at the beginning. Now we can proceed and plot this. So we're importing Plotly graph objects, taking a slice, which is the whole data frame for now, because we don't have a big data frame, I think. We're defining geo.figure, and then we're feeding the candlestick index at first, and then the open, high-low, and closing prices. So we have on the chart these candles that we can see here. And then we add on top of this chart, using the function add_scatter, the index. X is equal to the index, so they have to be the same index between the candlesticks and whatever I'm adding on the same chart. And y is equal to the SMA, so we're adding the SMA just to verify if our slope calculation is working correctly. So I'm using mode is equal to markers and providing a size and a color for the markers, and the name is equal to, let's call it SMA here. And we should compute the SMA first. Computing this one, slopes, and plot. So this is what we have. Those purple points are the values of the simple moving average for each of these candles. So let's check one slope, for example, index 59. it's a negative slope minus 0.6. So 59 should be this one around here. And that's true, we have a negative slope. And notice that from 59 until, let's say, 54, we should have probably almost the same slope, the same value. Let's check it out. So we have 59. If we say 59 minus 0.6, and anything before this is almost also minus 0.6. So it looks like it's almost the same slope. But then we have a positive slope, for example, around 80 or 79. Let's check it out. So here we're starting to have around 70 or something equal to 0. It's very close to 0, the slope. So let's check around 70. Yes, so we have an inflection point going from positive to negative. So we're very close to 0. So this is how we can verify that these are correct values, at least from the sign point of view, because whenever we have a negative slope, we should be seeing a descending or decreasing moving average. And whenever we see a positive slope here, we should be seeing an increasing or a climbing moving average. And if you are wondering why whenever we're slicing 30, we're getting a 49 here, it's because we didn't reset our index. We should be resetting our index whenever we are dropping the missing values rows. So data.reset index one more time, and I'm just putting in place is true, and we're going to drop the old index is also true. So now when we are slicing, we should get the same indexes. So if I'm slicing from 30, I'm starting from 30 here. I'll get this as a result. So now it works as we expect it to work. If we want to try again, you can have some time checking if these are working correctly. I know this indicator is working perfectly fine. So we are measuring the slopes and we can visually verify this on the plot. The second approach to measure or to detect a trend are the three moving averages alignment. And this is a bit simpler because we can simply compute three moving averages with three different lengths. For example, the SMA 10, 20, and 30, which we are computing using our previously defined function. So calculate _ SMA, we're providing data, the data frame, and then the length. So 10, 20, and 30. This is how we are adding these three new columns into our data frame. So whenever we run this, we can print the data frame and verify that we have three different moving averages through the SMA 10, SMA 20, and the SMA 30, which were concatenated to our data frame. Now we can continue and check the alignment. Remember that we need these to be aligned in a certain order. So whenever the fast moving average, which is the 10 length, is higher than the 20 moving average, the medium moving average, which is higher than the 30 moving average, we consider this as a slow moving average. And in this case, we have an uptrend. In the opposite case, when they are ordered in different directions, so 30 is above, 20 is above 10, we consider that we have a downtrend because the SMA is pointing downwards, but it's preceding the SMA 20, which is preceding the SMA 30, which is the slowest changing moving average here in our case. So we can test these here, determine trend function. So we're defining a new function, and it takes the data frame as an input parameter, and it has to have these three moving average columns. So if data SMA 10 is above, data SMA 20 is above, data SMA 30, then we return 2, which is an uptrend category. Else, if the opposite direction or the opposite alignment is verified, so the SMA 10 is below SMA 20, which is below SMA 30, then we have a downtrend and we return 1. In any other case, by default, we don't have any clear trend detection, we return 0. And now we can add a new column to our data frame. So data trend is equal to data.apply determine trend. So we're applying this function to any of these rows or to all the rows of the data frame. and along the axis would equal to 1 to work on the rows. Whenever we run this, this cell, now we can print the data frame, and we can see at the end we have a trend column that was added, and it has some zeros, it has some twos, and I'm sure that we have some downtrends, some ones somewhere along the data frame. Now we can plot this. We plot the 3 moving averages, and here we can verify for which candles or which slices of candles do we have the alignment verified, just to make sure that we didn't make any mistakes. So we can check, for example, the index 79 or 80, they have a trend 2, so this is an uptrend, which means that we have a certain alignment. Let's check. So here, so all of these candles starting from I would say 62 up to the end, up to 80, they have this alignment, so they are in an uptrend because the fastest moving average is above the 20, which is above the 30 length moving average. So you get the point. We're looking for this alignment to detect the trend, and for the opposite alignment, which is verified here, we have a downtrend. Notice the blue curve is faster in going down with the price. Then we have the medium curve, which is the red curve here, SMA 20, and then the slowest moving average, which is the SMA 30. In this third example, we're going to check how we can verify if the candles are above or below the moving average curve. We're looking for consecutive candles. They have to be a series of candles all above the moving average curve, in which case we consider we have an uptrend. And if they are all below the moving average curve, we consider we have a downtrend. We're going to do this in a function called check candles. We're defining this function. It takes the data frame as an input parameter. It takes the number of back candles. How many consecutive candles we need to have above or below the moving average curve before we consider that we have an uptrend or a downtrend. And the third parameter is the moving average column, which is a series containing the moving average values. So first we're starting by defining a list, which we call categories. And the first few candles cannot be computed. We can't have a signal for these candles because we don't have enough back candles at the beginning of the data frame to compute the category or the trend in this case. So for I in range, starting from back candles up to the length of data frame until the end of the data frame, if all the closing prices of these candles, I minus back candles up to I excluded, so the current candle, if all of these closing prices are above the moving average within the same slice of back candles, so with the same slice of candles, I minus back candles until I, so if all of these closing prices are above the moving average curve, then this is a category 2, it's an uptrend, and we're going to append the number 2 to our data, to our list, actually, to our categories list, which we're going to add later on to our data frame. Then else, if all the data closing prices within a candle slice are lower than or below the moving average curve, then we have a downtrend, so we append 1. And in any other case, we're appending 0 as a value, so this is the third category. We don't have any trend detected. And at the end, we return the categories list. And to add this into our data frame, we add a new column called category, which is equal to check candles function. We provide the data frame 5 for the number of back candles, which means that we have 5 back candles that are above or below the moving average curve. We consider that we have an uptrend or a downtrend respectively. And we're using the SMA 20 for this. We could use a different moving average length, but for now, for this example, we're using the SMA 20. I'm going to run this, and then we're going to check our data frame, have some values. So at the end, we should have the category column, which we can see here. We have a downtrend here. We don't have any trend detected here. Here it's a downtrend and so on. So let's check this visually. So we're plotting the candlesticks on the chart, and then we're adding the SMA 20 and we're going to verify manually or visually if we have these trends or these categories are correct. Let's check, for example, for any of these. Index 54. So the candle 54, it's an uptrend because the candles or 5 back candles before this particular candle were above the moving average curve. Let's check it out. So again, index 54. Let's plot this. So index 54, it's right here, 50, 51, 52, 3, and 54. It's this one. And if we check the previous candles, 1, 2, 3, 4, and 5, 5 of these closing prices were above the moving average curve. So this is how we detected that this is an uptrend or a short uptrend momentum for the price. Let's try and verify with another example. Let me check the last column. So we have 1 here, for example. So this is 29, candle 29 has a downtrend signal. 29 is around here, 29, and it's true, it's a downtrend because the 3 or 5 previous candles, they were below the moving average curve. So we are in a downtrend. And this is how we validated that it's working fine. Our function or our indicator is working well. So we have these 3 methods that we have just shown how to detect the trend of a price. You might want to try the 3 of those in your strategy and check which one works best for you. For the moment, I'm using this one. So I use the candles above or below the moving average curve. And the moving average curve length will depend on which time frame I'm working on. There's no good or bad. Some methods, some approaches, they work in some situations, and other methods, they provide better results in different situations. This is why we need to try with different parameters, different SMA lengths. I usually also use the EMA, the exponential moving average, instead of the simple moving average. You might want to try this one as well. You might want to switch from moving averages to the VWAP instead. In some places, the VWAP works better than the moving average, especially on lower time frames. I like to use it on the 15 minutes or the 5 minutes time frames because it kind of provides a virtual support or dynamic support and resistance level for the movements, for the fast movements or the short-term trends on these time frames or relatively fast time frames. So to do this, we can I'm downloading the data first of all with the interval 15 minutes. So we need a new time frame for the last 7 days, the Bitcoin and US dollar, always using the Y Finance for now. And then I'm adding to my data frame using the technical analysis package, the VWAP, using the VWAP function, and I'm appending it, append equal true. It's going to append these columns provided by the function to the data frame. So this is what it's printing here. So this is the VWAP values. We could verify this. So I'm adding code here, the code cell. I'm going to print data. And here we have the open, high, low, closing prices, the adjusted closing price, volume, and then the VWAP underscore D, which is the last column. So it's working. We have it. It's in our data frame. And now I'm going to add data category, if it's an uptrend or a downtrend. I'm using the check candles, which is the previous method that we computed or we explained using the moving average. So how many candles do I have, consecutive candles above or below the moving average curve? Now, instead of using the moving average curve, I'm going to use the VWAP column instead. And this function is going to check if I have 5 consecutive candles that are above or below the VWAP curve, in which case we have an uptrend or a downtrend, and the result is going to be saved in this new column data category in the data frame. So let's run this one. And this is how we can recycle previously defined functions. We don't have to redefine everything. Sometimes it's very simple to recycle. And I'm printing places or the rows where we have a data category different than 0. So we have a signal. We have this one here, for example, and this one, and so on. In this case, we can't reset the index to an integer because the VWAP needs it. It needs a date-time format, so this is why we kept it as a date-time format. Otherwise, the VWAP function wouldn't work. And now we have to look for candles when we plot this to verify if it's working properly. We have to look at these referring to the date-time index. Let's check this one. For example, we have a down signal, downtrend signal. This is the 9th of October at 1:15 time. Let's check it out. So the 9th of October is somewhere here. I'm going to zoom in. 5 and 1:15 is right here. So it's not a very nice signal, which means that 1, 2, 3, 4, and 5, all of these candles closing prices are below the VWAP curve. So actually it's working well because the closing prices of these two red candles are below the VWAP curve. This one is also has the opening and closing price also below the VWAP. This one apparently also has a closing price below the VWAP, and this one, but it's not as strong as signal, so it's not a very clear signal, I would say, in this case. We could verify another one, something a bit further. So 15th of October at 7:30 p.m. So we have an uptrend. Let's check 15th of October. So 7:30, yes, it's a clear signal. We have all of these previous candles, 5 candles are way above the VWAP curve, and we can see it's a short-term uptrend. So this can be detected using the VWAP curve as well, instead of using the moving average curve. Now to confirm the trend, which is the next step or the second step in building our trading system, we detect the trend and then we need to confirm the trend. It's an optional step, but sometimes in some trading systems it brings a lot of value, and it's good to confirm whatever we decided or whatever trend we detected. In this case, we are using the average directional index, the ADX, and I'm using the technical analysis package. I'm also concatenating whatever the ADX function is going to return to our data frame. And this is the result. So we have ADX 14, the length is equal to 14 now, to the positive directional index, and the negative directional index are here. So the MP14 and the MN for negative 14 as well. As you can see, we have these values. They must be concatenated to our data frame. And this is what we have at the end. So these are the last 3 columns that we've just added to our data frame. Now we can confirm the trend in 2 different ways, either by just using the ADX value, if it's above 30 or 50, whatever strength of confirmation we need to apply, or we can check the positive and negative directional indexes, whichever is above the other, because these are also an indicator of the trend. So we can use both of them at the same time as well if we desire. For this, I'm defining a new function called generate trend signal, and this is a function that would generate a signal based on the ADX. So it takes a data frame, the data, which is the first input parameter, and then we have the threshold, which is equal to 40 by default, which means that we would confirm a signal of a trend only if the ADX is above 40. So at first I have an empty list, which is trend signal, and then for I in range length of data, which means for all the candles or all the rows within the data frame, we're checking if the data ADX value of I, the current candle, is above the threshold. This is the must. So if it's above the threshold, we can continue with the other tests. Otherwise, we are adding zeros to our trend signal list, so we don't have any signal. So the first thing, we need to have an ADX above the threshold. And then if data DMP, so the positive indicator, is above the negative indicator, then the trend signal is 2. So this is an uptrend signal. And in the other case, where we have the positive one below the negative indicator, then in this case we append 1. This is a negative or a downtrend confirmation. So this is a function using the ADX to confirm the trend in some different way. To use it, we can either use it alone, or we can also use it in conjunction with the previous indicators, the VWAP, or the alignment of the three moving averages, or even the slope of the moving average. So we determine the trend, we detect the trend before, and then as a second step, we confirm it using the ADX. In these two lines, I'm just changing the names of the columns just to be able to use them as ADX and DM instead of ADX underscore the length of the ADX. This one is ADX underscore 14, DMP underscore 14, and DMN underscore 14. And I don't want to modify these names of the columns every time I have to run the function while changing, for example, the length of because here we can also apply the length, change the length to 15 or 16 and so on. So I don't need to change the name every time I'm changing the length of the ADX. This is why I'm renaming these. I'm just removing those underscore 14 and 15 and so on, just keeping ADX and DM as names of the columns. And then I'm creating a new column called trend signal, which is the ADX's signal, basically. And I'm calling generate trend signal, which is here. This is the function that we have just defined. And I'm only providing data, the data frame, as an input. And if I want to select only the rows where I have a signal which is different than 0, so if I have an uptrend using the ADX or a downtrend, we can verify this, which is the last column. So trend signal 1, 1, etc. So we have 2 here. Now we can create a new column called confirmed signal, and this is where we're going to compare the ADX signal with the previously mentioned and computed moving averages signal, or the VWAP signal, whatever we have computed before. So if both of these signals, the ADX and the moving average, are equal, then we return the same value of the category. If they are both confirming an uptrend, we return a signal that is equal to 2, which is an uptrend, a confirmed uptrend. And this is going to be saved in the column confirmed signal. If we have a confirmed downtrend, so both the category and the trend signal are equal to 1, then we return 1 and we save it as a downtrend confirmed signal in the confirmed signal column. And if we have different signals between the category and the trend signal, in this case we return 0 because we couldn't confirm, or both indicators are not confirming the same trend direction. We can verify if this is working by printing the rows where we have a confirmed signal different than 0, and we can compare the category and the trend signal. Let's check it out. So check these rows. So here, for example, we have a category 2, an uptrend from the moving average indicator, which is confirmed by the ADX, which is the trend signal. It's also equal to 2. And this is how the confirmed signal is also an uptrend equal to 2. And so on. So now we can verify the downtrend, 1, 1, and then 1, and so on. Now we could check for errors in our signal if it's happening. So this is where we would look for a category that is different than the trend signal. I'm going to put this, but at the same time, I'm going to use the bitwise operators here. So I need to put this in between parentheses in this case. And at the same time, we do have a confirmed signal that is different than 0. So we're looking for rows where we didn't have a confirmed signal between category and trend signal. So these were different, but at the same time, we had a confirmed signal that is different than 0. We shouldn't have any if everything is working properly. And that's correct. So if we run both of these cells, we get nothing here because we shouldn't be having any signal if the trend signal and the category are not the same. So in the previous lab, or in the previous Python applications, we saw how to detect a trend and how to confirm this trend. In this program, in this Jupyter Notebook examples, we're going to see how to generate entry signals. And these are based on 3 different approaches for these examples. So the first one we're going to discuss together is the entry based on Bollinger Bands and candles crossing the bands, the upper curve of the band or the lower curve of the band. Then the second case we're going to discuss together is the entry based on RSI values combined together with the Bollinger Bands values. And the third example is the entry based on a rejection candle happening next to the Bollinger Band's edges. This could mean the upper or the lower curve of the Bollinger Band. In this first cell, we are using yFinance, we're using Pandas and Pandas technical analysis because we need to compute the Bollinger Bands and any other indicator using Pandas technical analysis package. So I'm defining a function called get_data. It takes the symbol of the data we would like to download. In this case, I'm using the Bitcoin US dollar for this example. And then we're going to use the download function from the yFinance, and I'm passing the symbol here. So the Bitcoin US dollar in this case for a period of 300 days. And we're using the daily time frame. So this should be roughly around 300 rows of data. Then we're resetting the index and we're returning the data frame. And to get this data, we're using the function get_data, passing the symbol Bitcoin US dollar, and whatever is returned, so the data frame as a result, is stored in a variable called data. Just to make sure that things are working properly so far, I'm going to print the content of the data frame, and we can see that we have the open, high-low closing price, the adjusted closing price, and the volume column, along with an integer index because we have resetted the index so we don't have the datetime format anymore. Now we can compute the Bollinger Bands using the technical analysis bbands function. The length is equal to 10 for now, and the standard deviation is equal to 1.5 because I'm not looking to be very selective in this case. So instead of 2 by default, I'm using a 1.5 standard deviation. Append is equal to true is to append the results of the Bollinger Bands function to the data frame. So whatever columns I'm going to get, the upper curve, the lower curve of the Bollinger Bands, and the middle curve, which is the moving average, and whatever comes with it is going to be concatenated as extra columns to this data frame. And to avoid any naming problems later on, because this function from technical analysis, bbands, is going to add to the columns names the length, which is 10, and the standard deviation value, so 1.5. So the columns Bollinger Band upper 10 and 1.5 and Bollinger Band lower 10, 1.5 and so on are going to be added to the data frame. Just to make it a bit more general and to make things easier for us later on, I'm just going to copy the content of these columns into new columns called upper band and lower band, because these are the bands that we're going to be using. These are the curves that we are going to be using as indicators. Then I'm defining a new function called calculate SMA for simple moving average. Takes the data frame and then the length for the moving average computation. And I'm returning from technical analysis the SMA function or the result of the SMA function, providing the closing prices for the function and the length as well. So now we can use calculate SMA, calculate underscore SMA, data, and 20 to compute the 20 candles or 20 days length simple moving average. And I'm putting this as a new column in our data frame, which title is SMA. So now we have an extra feature. We have the Bollinger Bands, and we also have the simple moving average with length equal 20. And since the moving average of length 20 is going to skip the first 20 rows or 20 candles to compute the moving average, because we need at least 20 values to compute the first value of the moving average, we're going to drop an A, so to drop the first 20 rows in this case, and we're going to get a new data frame. I'm going to run this cell again, and I'm going to print the data frame to show the content. So we have the open, high, low, close, the adjusted close, the volume, then we have the Bollinger Bands, the lower curve, the upper curve, or the middle curve, then the upper curve, some other measurements for the Bollinger Bands. But I'm interested here in this example with the upper band and the lower band. And notice the upper band is nothing but this same one. So BBU 10.5. So we have the same values. So 18,000, 2027. And here we have 18,000, 2027. Same thing for the lower band is nothing but BBL then 1.5. So we can compare the values and we can see that these are the same columns that we have just copied under different names. At the end, we have the SMA, our last column so far. Now I'm going to add one more trend detector that we have used in previous videos, which is the check candles. I'm going to check within the data frame for each candle if the previous candles, like the number of back candles or number of previous back candles, are above or below the moving average column or the moving average value, in which case we consider we have an uptrend or a downtrend. We have seen this function before, it was explained. I'm just using it here to detect the trend, the current trend, and I'm saving the values of the trend categories into a new column in our data frame called trend, where I'm using check candles for the data, and then I'm using 7 back candles. So in other words, we need to have 7 consecutive candles either above or below the SMA curve. Consider that we have an uptrend or a downtrend respectively. So now we can check the content of the data frame again. We have the open, high, low closing price, the adjusted close, the volume, and any other columns that we already had. And now we have an additional column, which is the trend, where we have 3 values for 3 different categories, either 0, so no detected trend, and we have 1 for a negative detected trend or a downtrend, and 2 for an upper or an uptrend detected using this function, which is checking the candles are above or below the curve of the moving average. Okay, so now we have our data frame, we have these columns, we have the Bollinger Bands, and we have the moving average as well as the trend category as a feature. So we can try and use the Bollinger Bands now with the candles crossing conditions together to generate an entry signal. The idea for this first example is to check if we have an uptrend and at the same time if we have a retracement below the lower Bollinger Band. And whenever we detect a candle crossing the Bollinger Band, the lower Bollinger Band, in the up direction, so it opened below the Bollinger Band and it closed above the lower band. In this case, whenever we have this happening with an uptrend, a general uptrend, we consider that the future forecasted trend of the price, at least for the short term, is in up direction. This is our theory, and we can test it immediately with this indicator. So to do this, first of all, I'm defining a new column called entry. So it's an entry signal, which is equal to 0 at the moment. So no entry signals for now. And then we set the conditions for an entry category 2. So this is a long position or a buying entry. So buy entry conditions are equal to the following. We have a data trend that should be equal to 2. So we need to have a general price trend in the upward direction. And at the same time, we need to have the data open of the current candle should be below the lower band curve, and the closing of the same candle should be above the lower band. So we're crossing the band from the lower band of the Bollingers from bottom to top in an uptrend. In this case, we're going to locate the buy entry condition, the column entry, and it's going to be equal to 2. The buy entry condition is going to be false or true, and it's going to check for which rows we have these conditions validated. And in this case, it's going to put 2 for all of these rows just in the entry column. Same thing, it's a symmetrical problem. We can generate sell entry conditions, can generate selling entries or short positions, short signals. So for this, we need to be in a downtrend. At the same time, we need a candle that crossed the upper band from top to bottom. So it opened above the upper band and it closed below the upper band. In this case, we generate a signal which is equal to 1. So this is a short position signal. And to have an idea on the kind of data we have now, we can print all the rows where we don't have signal equal to 0. So I'm printing from the data frame called data any row where data entry is different than 0. So we have an entry that is equal to 2. Okay, so this is a bullish signal, and this one is a bearish entry position or an entry signal. Let's check these candles. So candle 195, we can plot these candles. So I'm plotting the candles, the open, high, low, and closing prices, and I'm adding on top of the candlestick charts the SMA, the moving average, just to guide the eye for the trend. And I'm adding the lower band and the upper Bollinger Band as well. We have these on the charts, and we're going to look for, first of all, the candle 195. So it should be somewhere around here. Going to zoom in. So 195 is this one. As we can see, we are in an uptrend because we are above the moving average curve. But at the same time, we have a candle crossing this green candle right here, crossing the lower Bollinger Band from bottom to top. We are entering in the zone of the Bollinger Bands. And then notice that the price continues going up. So this was a bullish entry signal, and it was a good signal, in fact. So this is a good indicator as an entry indicator. Let's check the other one. So we have 221. It's a short signal. It's a shorting signal, category 1. So 221 is around here. So we have, indeed, we have a downtrend because this is the red curve, the moving average, and all the candles before this candle, 2021, are below the curve. So we are in a downtrend. So we're looking for a short position. And at the same time, we had this red candle, 221, crossing the upper band from up bottom. In this case, we consider this as a shorting position, the shorting signal. And if we would have taken this trade, provided that we know where to put our stop loss, but then we had this quick decrease in the price. So I don't think it's related because these are daily. We're working on a daily time frame. So each of these candles represents a day. In this case, we would have waited almost 2 weeks to get this movement, this price movement. But still, I think it was a good signal, although the future was a bit unpredictable. The second example is combining the RSI values and the Bollinger Bands as well. So for using the RSI, we need to compute the RSI. So I'm defining a new function called add RSI column to the data frame data. So what it does, it's going to compute the RSI using the closing prices in the close column. It's going to create a new column in the data frame called RSI, going to return the whole data frame. So in this case, I'm putting data is equal to add RSI column, and the input parameter is data itself. So now we have the RSI. We can run this, make sure that we have it. I'm going to add print data and go to the extreme right. You can see that we have the RSI column that is added right here. Okay, so it's working. The function is working. What do we do with it? We're defining a new function, another function called the RSI signal, and it takes the data frame and it's going to add a column called the RSI signal. Is it a positive signal, negative trend signal, or no signal at all? 0. So for a bullish signal, we're going to put 2. We're going to insert 2 as a value. For a bearish signal, we're going to insert 1. The conditions are the following. So we're going to locate places where we have the closing price below the lower Bollinger Band. So any candle that closes below the lower Bollinger Band, and at the same time we have a data RSI, so an RSI value at that particular point that is lower than 55, we consider that this is enough to forecast a short-term uptrend. So the RSI signal in this case is going to be equal to 2. In the opposite direction, if we have a closing candle above the upper band and at the same time an RSI value above 45, so not going too much in a downtrend, so the RSI can show the trend strength sometimes. So if the RSI, for example, is below 20, this indicates that we have a very strong downtrend. We're trying to look for some specific values of the RSI. And in this case, if these two conditions are verified, then in the RSI signal category, we're going to insert 1. So this is our shorting indicator. And we're going to return the data frame with these signals. Let's run this cell, and I'm going to run the function RSI signal, providing the data frame as an argument. And we can print the signals now where the RSI signal is different than 0. Let's try this. So we have all of these columns where we had the conditions verified. Now there's only one way if you are questioning the validity of this entry signal, the RSI signal. Is it working? Is it worth using such a signal? We can test it right here. We don't need to do a full backtest using the previous chapter's descriptions and how we have defined how we can statistically compute and validate an entry signal. We can use the same procedure here. So again, in this indicator, we're checking if we have a closing price below the lower band and an RSI value below 55, in which case we consider we have a bullish signal. And in the opposite case, if the closing price is above the upper band and at the same time the RSI is above 45 of value, so our RSI signal is bearish. And we can combine this together with other indicators. Let's check it out. So I'm defining a new column called entry. So this is the entry signal, which is equal to 0 in the data frame so far. And then I'm defining the buying entry conditions. And these are the following. So we need to have an upper trend. We also need an RSI signal that also shows a bullish configuration. We need to have the low price of the current candle below the lower Bollinger Band. If we have these three conditions together, we consider we have a bullish pattern or a bullish reaction. We're forecasting a future bullish reaction of the price, and in which case we are storing this as category 2 as a signal in the entry column. The opposite direction, if we are in a downtrend, the RSI signal is a downtrend as well, is bearish, and at the same time we have a high of the current candle above the upper Bollinger Band, and we have a bearish forecasted price movement. So we're running this cell, and then we're printing all the rows or all the days where we have non-zero signals. So we have bullish and bearish signals. In order to validate these, if you are questioning the validity of such examples or such indicators, there's only one way to find out: a full backtest. Good idea. But if you want to go the short way, you can also plot these and check manually what's happening, what's the behavior of the price after these particular candles. To us to tune these parameters and these coefficients to get the best results for our strategy. Now we can combine the signal with Bollinger Band signal to detect a good entry position. Putting two conditions here. We need to have a rejection candle that is bullish, and at the same time we need a lower value, the low value of the current candle, to be happening below the lower Bollinger Band. In this case, we are expecting a future uptrend. This is why it's a category equal to 2 in the entry positions. At the same time, if we have a rejection candle showing a bearish pattern, and it's happening where the high price of the current candle is above the upper Bollinger Band, we expect the price to go back down, to retrace back down to the Bollinger Band zone. And this is why we are putting category equal 1 as an entry signal. We can run this, and I'm going to print those signals where we have an entry signal that is different than 0. We notice that we have a bearish signal for candle equal 40, so the index 40, we can check it out on the chart. So we can run this. So 40 is this one. It's a good bearish signal. It's going down, the price is going down, so this is a good indicator so far. Let's check the others. So we have 76 and 80. So 76 is a bullish signal. Let's check it out. 76, this one, it's a perfect bullish signal. After a rejection happening below the Bollinger Band, everything is going up, the price is climbing up. Let's check more signals. So far our strategy looks promising. So 80 is a bearish signal, which is a false one, so we would have been stopped at this point probably, because it's happening above the upper Bollinger Band. and it's showing a strong rejection in the bearish direction, but the price didn't retrace back to the inside of the Bollinger Bands in this case. The next one we can check is, we can verify, is the 139. 139 is located around here. It's a perfect signal as well. It's a rejection, bullish rejection candle happening below the Bollinger Band. A good signal, a good upper trend signal, but then the price didn't climb back up immediately. It took some time before it showed this uptrend momentum. And we can go on verifying. 152 is a bullish candle. It's a perfect signal. Then the price went immediately up, as you can see. We also have another one. So 194. 194 is a false signal, for example. So we can filter these false signals because here we can notice that we have a very narrow Bollinger Band. Two bands, the upper and the lower bands, are very close to each other's. In this case, we have one candle covering the whole Bollinger Band range. So we don't have to consider these candles. We can avoid these signals where the whole candle covers or touches both the upper and the lower curve. There's no way we can have a trend within this zone because the volatility is so low. Bollinger Bands are so squeezed and signals are meaningless in this case. So this is it for this practice session and our Python examples. We've seen 3 different ways to generate entry signals. Could it be with the trend, without the trend? It depends on the strategy you're trying to build. Remember that these are just examples. You can combine any indicator or any couple of indicators together to generate your own entry signals if you have a strategy in mind that you need to program. In this section of the course, we will go through backtesting strategies and trading systems, and we will build a profitable trading strategy together. We will analyze the results and see how we can optimize some parameters to increase our profits. Before we dive into the complexities of creating and testing our trading algorithms, it's important to go through a backtesting checklist. This checklist ensures that we have all the necessary components in place to effectively test our trading strategies. Will make our programming easy, our backtesting easy, and writing the code in Python much easier if we already know a pre-planned checklist for our trading system. So firstly, we need to define our trend indicators and entry signals. As we have seen in previous sections, trend indicators are statistical measures that we will use to forecast market trends, or at least to detect the current trend status. These indicators can change from simple moving averages to more complex ones like the relative strength index or Bollinger Bands. So we need to choose one that we will be using in our system. This goes along with market entry signals as well. So we'll also need the entry indicators and a specific set of conditions that, when met, will trigger a trade. So far in this course, this first step shouldn't be a problem because we have already introduced some of these methods in Python as shown in the previous examples. Next, we need to establish our lot sizing rules. So now this is not a mandatory step if you have one specific trading system, but in some cases it will allow you to limit your risk and therefore stick to a minimal drawdown when the market is difficult to trade. Lot sizing determines the number of units of the asset that we will buy or sell in each trade. This can be a fixed number or it can be dynamic, changing according to various factors such as the volatility of the market or the asset or the size of our trading account as well. Then we need to define our trade management rules. This includes our exit strategy, which determines when we will close our trades. This could be a specific profit target, a specific stop loss level, or a specific signal from our indicators. We also need to decide whether we will close our trades partially or totally depending on the market. And partial closing allows us to lock in some profits while still keeping a position open in case the price continues to move in our favor. And these are the 3 essential components of our checklist. So whenever you are reading strategies to get inspired and build your own system, you might want to keep this checklist in mind and extract whatever is needed for your strategy. At this point, it's good to remind that backtesting is an essential part of algorithmic trading. You need to backtest every single strategy before you deploy it live. as this will allow us to test our strategies on historical data to see how they would have performed so far. And at the same time, very important point, it will allow us to tune the parameters of our trading indicators to maximize our profits. Actually, this is one of the main advantages of algorithmic trading and backtesting, of course. So it will help us refine and improve our trading strategies. In the next videos, we will dive deeper into the full backtesting process using each of these components, and we will show how to implement them together in our trading algorithms, using Python, of course. Then we will have a brief on the quality of the results and how you can evaluate a trading system from backtesting results. Before we start the backtest implementation, let's take a look at our options and what are the libraries that are available in Python to assist us in the backtesting process. Some of these tools might not be maintained or updated anymore, so we will just list these here to provide the options and to highlight the possibilities that we have in Python. The first tool I'm going to talk about is Zipline. It's an open source backtesting engine that was last updated in 2020. It was developed by Quantopian, a platform for building and testing trading strategies. One of the key advantages of Zipline is that it supports both backtesting and live trading. This means that you can use the same code to backtest your strategy on historical data and then execute the code or execute trades in a live market. This is a significant advantage as it allows for seamless transition from backtesting to live trading. Zipline also integrates well with other Python libraries such as NumPy, Pandas, and Matplotlib. This makes it easier to manipulate data, perform complex calculations, and visualize your backtesting results. In addition, Zipline supports trading of both equities and futures. This flexibility allows you to backtest strategies across different asset classes using the same library. However, Zipline is not without its drawbacks. So one of the main challenges with Zipline is that it can be difficult to install and use, especially for beginners. It requires a specific setup and understanding of its architecture to use effectively. Furthermore, while Zipline has extensive documentation, it can be difficult to navigate, particularly for those new to algorithmic trading. The learning curve can be steep, but once you get the hang of it, Zipline can be a powerful tool for backtesting trading strategies. Other tools are also available if you are using Python, but some of them, as we have already mentioned, were updated last in 2018, so the maintenance might not be very active anymore for these tools. So we have PyAlgoTrade with some pros and some cons. You can pause the video and read through. It's not what we will be using for this backtesting during this course. Then we have Catalyst. So it's no longer actively maintained since the end of 2018 again. So it's a project actually from Zipline that we have already mentioned and specifically designed for cryptocurrencies. So it supports live trading and backtesting, and it can ingest data from several popular cryptocurrency exchanges. So also it has some cons. The project is not as actively developed or maintained as some of the other libraries. So this is the main drawback, because usually the documentation might be also limited. So you might suffer if you try and use one of these tools where you wouldn't find enough information online because simply the maintenance is very slow and people are not using it anymore. And some of these tools do not integrate well with the built-in Python libraries, like PyAlgoTrade, for example, doesn't support Pandas data frame objects, which can limit its functionalities sometimes. So we all use Pandas from time to time, and it's probably an important point to consider before you choose the tool you will be using for backtesting your strategies. Backtrader is a good candidate. It's flexible, modular, and fast backtesting library for Python. It allows for strategy optimization and advanced risk analysis. And it also supports live trading with a number of brokers, including interactive brokers, Oanda, and Alpaca. So if you want to use something, this Backtrader here is one of the best candidates, in my opinion, looking at the whole spectrum of the tools that are available today. Another package that is also as important is VectorBT, so Vector Backtrader. This package actually emphasizes on speed and flexibility. So it might not be the best, but it's for sure the fastest if you want to optimize your strategies and to test your strategies over a wide list of assets, because it uses vectorized computation. So it's extremely performant. It's built almost entirely using Numba compiled components, which give it excellent speed. It can often backtest thousands of different combinations in the time it would take another library to process a single backtest. So we might think of it as almost 20 or 30 times faster than any other backtesting tool. And this is the main advantage of VectorBT. There's no other reason you would choose VectorBT over other packages, except the fact that maybe you want to optimize, and often optimization of the trading system on different variables, different parameters, and different assets, and so on. This can lead to a number of historical backtesting operations, which can take a lot of time if you're using normal libraries. VectorBT is your choice here. So it uses a vectorized approach, which allows for fast computations and the ability to test many variations of a strategy very quickly. The API is designed with a strong focus on simplicity and consistency. That's true. But where I suffered actually from this is the documentation. So it's highly performant, but it can take us a while to get used to the library. And the documentation might be challenging. So it's not the best documentation I have seen, because not all the details are mentioned there. They're probably working on it in the time we are watching this course. It's still kind of challenging relatively, or if you compare it with the documentation of other packages. So then we can check backtesting.py, which is the package we will be using to backtest our strategy during this course. So I like it because it's simple, it's easy to install, it has excellent documentation. The syntax is very familiar to those who have used Backtrader. So if you want a clone of it or something very similar that would also help you deploy your strategies live, we can switch easily from backtesting.py to Backtrader because they have the same structure and almost the same syntax, making it easy to pick up as well. So it is event driven. So you program the logic that is run on each bar or each candle successively, much like you were actually trading the strategy day to day. It allows you to bring your own indicator libraries. So we can include Pandas TA, technical analysis, as backtesting doesn't come preloaded with any built-in technical analysis or technical indicators. It comes with some preloaded data, making it easy to get started if you want a quick example or a quick backtesting example, which is not bad. The cons, however, it's a lightweight and all, but it may not offer all the advanced features provided by some other more comprehensive libraries, like it doesn't support live trading, for example. So once you backtest your strategy, you have to code it on its own, on its side, outside of the backtest or outside of backtesting.py framework to deploy it and trade live with it. So that might be a bit of a slowdown, but in any other circumstances, this is the most advantageous package I have seen. If you want to pick up something to backtest for the first time using Python, this is the easiest package to learn and to use and to get started very quickly. So the library doesn't have a built-in support for live trading, and this is where I think it's the major drawdown for this one if we compare it with the other packages. There are other tools with different specs. I'll not go through all the list for our testing. And for the purpose of this course, we will stick with backtesting.py. It's a great package to start with. So if you are curious and you want to know, you can check the list here, and it's not exhaustive. So a lot of other tools are also available online. You might want to go and Google things around and check what are the options and see if anything else would fit your needs better than backtesting. In this notebook, we will introduce the backtesting library with some of its features, starting from basic setup to running complex backtests on trading strategies. Just a reminder, these Jupyter notebooks I'm using during this course are downloadable, so look for the links in the resources sections of each video. The first step is to install the backtesting.py library. You can install it using pip So if you are using a Jupyter notebook, you can simply type !pip install backtesting in one of the cells. And when you run the cell, you will get the necessary files and it starts to download and install your backtesting library. I already have it installed on my machine, so this is why we can see these messages, because these were already satisfied. However, I think I can upgrade it because there are different versions, and I think I can update it from the Git repository. The easiest is to use pip for the moment, so stick to this one and we'll go on with our examples. Once the installation is complete, we can import the necessary modules, and this is where from backtesting I'm importing backtest and strategy. And from some of the, if you want to test pre-built strategies that are coming with the package, you can also include these or import these, but this is not mandatory if you are building your own strategy. Most importantly, you will have to import these two, so the backtest and the strategy. These are objects or classes that you might want to inherit from, as we are doing in this class right here. So we're inheriting from the strategy class. Okay, let's start by building a simple strategy just to learn how to use the backtesting package. We'll choose a moving average crossover strategy. This strategy involves monitoring two moving averages and making a trade when one crosses the other. So this is a classic in trading. I think you have seen it anywhere before, probably somewhere around the web or in one of those forums of trading. And here's how to implement this strategy using backtesting. So first we're defining a function, simple moving average function. So SMA, it takes the values and then the n, which is the length of the moving average. And this is just to return the simple moving average. This is why we are applying on the values a rolling window, and then we are computing the mean over this window. It's just a rolling window with the moving average over the whole set of data. And we're going to use this function later on in our strategy using two lengths. So using the parameter n, n1 is equal to 10 and n2 is equal to 20. Most importantly, notice that we're defining a new class, SMA cross, and it inherits from the base class strategy. At this point, just as a reminder, if you're not familiar with object-oriented programming in Python and those Python attributes within classes, and if you don't feel comfortable with Python in general, I have 3 other courses from Python Basics, another one on object-oriented programming, and a third one dedicated to pandas and NumPy and data wrangling and data analysis using pandas and NumPy. These courses come with their exercises. I think they will help you feel comfortable with these complex approaches that we are using in Python. Going back to our strategy, we're going to use two lengths for the moving averages, the 10 and 20. And we are defining this class that inherits from the strategy class that we have just imported from backtesting package. And then we're defining the constructor, so def initialize, and we're going to pre-compute the two moving averages. At this point, we're going to save these into variables, instance variables, the SMA1 and the SMA2. So we're simply calling the function, and we're using two variables to store the simple moving averages with the two lengths inside of the class. Notice also that we have used the capital I here, which is the indicator. So we're putting whatever we have here as an indicator for the class. This is inherited from the strategy base class, so you can redefine your indicator. Now, if the SMA1 crosses above the SMA2, we're going to close any existing short trades and buy the asset. And this is happening here. So if crossover self.sma and self.sma2, so we're comparing SMA1 and 2, in this case, self_position.close and then self.buy. Because if the SMA1, which is the fastest moving average, is crossing above the SMA2, which is the slower one, the slower moving average, in this case, we consider we have an uptrend. We can't keep shorting the market anymore. We have to go long. So we will close any short trades and we'll open long trades instead. In the opposite direction, if the crossover is SMA2 on top of SMA1, so SMA1 is going below, it's rushing the SMA2 down in the downtrend. In this case, we close the long trades and we sell the asset. We go short because we have a downtrend. So that's it. This is all our strategy. And we will execute this sell, run this sell. And then to run the strategy, we need a data. So we've seen how to download data using YFinance. It's the easiest and the fastest way to do so. I'm using the Bitcoin US dollar here, using just the default parameters. And we're running the backtest using this function. So BT, the variable BT, is equal to backtest with the data and the strategy that we have just defined in our previous cell. So it's called SMA cross right here. That's what we're using. And the backtest function is what we have imported here from the backtesting package. So basically from the backtesting package, we're importing two classes, the backtest and the strategy. Strategy will serve to define our strategy. We're inheriting from this one to build our strategy. And the backtest is to run the backtest. So it requires at least the data, a data frame with the data, the historical data for an asset, and then the strategy class. And then we can simply run it using bt.run function. And when I run this one, we can see that it's quite fast. It doesn't take too much time, including the downloading of the data. So we don't have to re-download the data every time. So we can isolate these in another cell, which is better in my opinion. So here we have the results. I'm not going through the details now. We're going to see this in the next videos. But notice that we have a return of 1,542% and a drawdown of minus 90%. So already we have a first backtest in this course. We can see that we have access to all the details regarding these strategies and all the parameters to decide the win rate, the best trade percentage, the worst trade percentage, and so on. Now there's a slightly different way to access these results, and in my opinion it's better. I'm going to define the variable stats, and I'm going to store whatever comes out of bt.run in this variable. So I'll run this again, and we don't need this part anymore. Now we can print stats, and this way you can have access to this information anytime in the program. So you can define or have access to the values of these. So if I print stats 0, for example, I will just get the date, while stats 1 will provide me the other element, which is the end date. And stats 3, for example, I don't know what this is, but you get the point. So we can access these values one at a time. In case you want to optimize a strategy, you might want to access these values and compare these with the different versions of your strategy. So this is why we are going into the details here of accessing the stats and these values. Maybe you want to compare the returns and store these into another list. So to plot these into a graph showing how the returns of your strategy is changing versus the, I don't know, the stop loss take profit ratio, for example, the risk reward ratio, or versus any other parameter of your strategy. I find this very useful, and you better keep it in mind in case you want to optimize your strategies in the future. So basically it's printing a pandas series object with various statistics such as the total return, the annual return, the maximum drawdown, and others, and we have all the access to all these details. But we can also extract the series of trades made by the backtesting package for further analysis. For example, instead of this, I'm going to print stats trades, so underscore trades, and this should be between quotes, single quotes would work. And I'm casting it to string, see what we have. And now we have all the trades that happened in our strategy. So the duration of the trade, the entry and exit times, we have the return percentage, the profit versus a loss. So if it's a negative value, so we have a loss. In this case, this one is a profitable trade. and we have the exit price, the entry price, the entry bar, exit bar. These are integers. And then we have the size, what was the lot size in this case. Sizes are changing because these were decided automatically by backtesting, by the backtesting strategy. So we didn't define the position size in our functions here. So it's taken by default as the whole sum that you have in your account. Now we can also visualize our results using bt.plot. There's a function that would allow you to plot the results on graphs like this one. So we have the candle patterns. We can zoom in and we can see the candles. We can also see the moving averages, which are the indicators we have been using for this strategy, the crossovers happening. And we can also see the trades. So this one is an open trade here. It's a winning trade because it's in green. It was opened here and then it was closed right here. And it was opened because we had this crossover right here. So whenever we had this crossover, this trade was closed and this one was opened, and so on. So we can see the equity on the upper side of the graph. So here the equity is increasing. It reached a peak right here and then it started going down again. So the strategy is not always working well depending on the market conditions. And these triangles are the trades. So we can know from the size of the triangle if it's a green trade, actually winning trade, and if we have a red one, means it's a losing trade. And the size of the triangle will show you relatively how big was your loss or your win. So you get the point. We have the trades, we have the equity, we have the candlesticks and the trades on top of these, as well as the indicators. We have all the data we need, the dates, and so on. So I think it's a great feature that we can see this visually, so we can observe how the strategies are behaving over time. Backtesting package also provides a method for optimizing strategies. So we can use the backtest.optimize function or method in this case instead of the bt.run that we just used in the previous cell for a normal backtest. So here we're trying to optimize using a grid search, and the two parameters that we are going to optimize upon are the N1 and the N2, which are the length of the moving averages. Remember, we have two moving averages in this strategy, and these are the length of these two moving averages that we have defined in these two variables here within the class SMA cross that we have defined. So we can use a grid search. This is a dictionary that's called parameter grid, and it has the values of N1 and the values of N2 I want to include in the test. So I'm using the range function from 10 to 30 in this case with the step 5. So it's going to be 10, 15, 20, 25, and so on. So 30 is excluded in this case. Then we have for the N2, we have 20, 25, 30, 35, 40, up to 45. So the optimize method is going to try all of these parameters values, and it's going to allow us to discover which pair of parameters will provide the best results. So as the name says, we are optimizing the strategy here. We're optimizing our parameters to provide the best results we can using these two indicators, which are the two moving averages. For example, I've run this here using the bt.optimize. I'm passing the dictionary for the method for the function, and I'm just leaving the other parameters by default. So it's a grid search by default, and we can print the return percentage. So this is the return in percentage. This is 30,000% as a return. Compared to the previous values where we didn't optimize, we got 1,500%. So here we're getting something much better, and we can print the parameters that led to these results. So using the results strategy key right here. So it's the SMA cross. In this case, N1 is equal to 10 and N2 is equal to 45. If I want to verify if this is correct or true, we can go back here and put 45 instead of 20. I'm running this again. I'm running the test again, and we can print the stats now, And instead of 1,500% in returns, we should be getting 30,000%, which is true. So this is the maximum that we can find so far within this grid. Of course, we can expand our grid. Instead of from 10 to 30, I'm going to put from 5 up to, I don't know, 60 in this case. And here, instead of 20, I can start with 10 up to 80 or 90 with a step of 5. So of course, the more elements you are adding, the more values we're adding, the more time it's going to take to find the optimal values. Notice that now it's taking more computing time, but that's okay. It's still relatively fast. And we're still stuck at the same results, so 30,000%, and N1 is equal to 10 and N2 is equal to 45. It seems like with this kind of strategy, this is we've saturated our profits. This is the maximum that we can reach, and we don't have to search anymore because we're not going to get anywhere, unless if we are adding additional parameters and additional indicators in here to improve our results. And I also have access to all the details of the results. If I print simply the results series, which is this one, I'm going to get all the parameters of the results that we are supposed to be going through. So we have the start date of the backtest, the end date, and this is depending on the data I'm feeding into the into my strategy. Then we have the duration in days. As you can see, we have the exposure time, 98%. The equity final in dollars. So this is, we started, I think, with 100K and we're ending up with $3 million. Equity peak was 4 million. That's huge, but we had a drawdown. The return percentage is 30%. Actually, let's try and plot it. Since we are using now 10 and 45 now in this backtest, we can plot this one. And as we can see, we have a better equity actually. It's increasing. We still have a drawdown. Of course, this is not a very complex system that we're trading with, but it's not bad taking the optimized version of it. So it's better than the previous one anyways. Back to our results, we have the return percentage, 30,000%. Buy and hold return percentage is 6,464%. So this is a good comparison baseline. We can always compare our results versus the buy and hold return percentage. And then we have the annual returns. So this is per year, 87%. Volatility annual percentage, 129%. And then we have the Sharpe, Sortino, and Kalmar ratio that we're going to explain in the next videos. We're going to go through these in detail to see how we can use them to evaluate our strategy and our backtest. Then we have the maximum drawdown percentage, minus 63 or 64% here. The average drawdown percentage is minus 10%. The maximum drawdown duration is 637 days. So we dived into a drawdown for almost 2 years. This is a bad strategy, I think. And then the average drawdown duration is 36 days. This is not bad. We could have a bad month. Then the number of trades, we had 79 trades. The best trade percentage is 348%. That's the maximum winning we've got in one single trade. The win rate is 46%, so only 46 or 47% of our trades are winning trades. And the worst trade percentage is minus 20%. That's not bad if we take the best trade percentage versus the worst one. That's a good comparison. So the strategy is working well from this perspective. The average trade percentage is 7.57%. So although we have 46% as a win rate, the amount that we are winning per trade, whenever we have a winning trade, is compensating somehow for the losses. And this is why we have a percentage, a positive percentage as an average trade percentage. The maximum trade duration is 194 days. That's very bad. Keep in mind commissions, fees, and overnight commissions and swap and so on. Then we have the average trade duration, 42 days. That's okay if we're working on the daily time frame or the weekly time frame. We have the profit factor and many other parameters that are not seen here. If we want to check all of them, we can print the index, and we reached the profit factor because here we have some missing keys that were not displayed. So let's check this. Maximum duration. So we are at the profit factor. We have the expectancy percentage, the SQN, the strategy that we have used to check for the best two parameters here. So I've used the key strategy, which is providing us the name of the class with the two parameters values. Then we have the equity curve and the trades. So these are also elements that we need to check. So the trades, we've already seen how to use it. So I can simply use the brackets and underscore trades. There we go. So we have access to all the trades that we have. And the other one that we need to investigate is the equity curve as well. Let's check the data within this. And here we go. So we have the value of the equity and how it's changing with the index, which is the date. So along the time, covering the whole data set that we have. So this was a quick introduction to backtesting.py package. It's a powerful tool for backtesting our trading strategies in Python. As you may have noticed, it provides a very simple and intuitive API. It allows us to define strategies, run backtests, analyze results, and optimize our strategies as well. And this is very important. With this tool, we can test and improve our strategies using historical data and then gain insights that can help us make better trading decisions. So this will conclude our video for now. If you feel that you need to know more about backtesting.py, we can visit their documentation, their online website, and they provide a lot of examples, and it's really a good documentation, so you wouldn't need to suffer much before you find what you're looking for.